The second largest bank failure in US history just occurred, and it only took 48 hours. Welcome to Creative Money, the show that helps you make money in creative ways. Today, a little something different. We're looking at the Silicon Valley Bank collapse. What happened? What went wrong? Who was involved? And what's next? So, what happened? Well, long story short, a classic bank run. Well, more of a modern day 48-hour digital only bank run. So fast, it was the fastest bank failure in US history. Yay! Capitalism's working really well. Silicon Valley Bank, or SVB, is mostly associated with tech startups who have seen a massive reduction in investments in the last year. Thanks to rising interest rates on loans, venture capital firms have not been giving out as much money to these startups, so these startups are having to draw cash from their reserves within SVB instead of having any new money coming in, because a lot of these companies are years away from profitability, so their only cash flow is investments. So what went wrong? Well, here's the timeline. On Wednesday, SVB released a press release saying, hey, we've sold a lot of treasury bond securities, aka government bonds, at a rather significant loss because we need some cash. Everybody's investments are fine. We cut a little bit of a loss because we need to free up some cash because of all the withdrawals that have been happening. This is normally expected when you're a publicly traded company and in the business of making big money moves. However, in this case, it didn't go according to plan. You see, SVB needed liquid cash fast, about $225 billion worth fast. That's a lot of money, and it's tough to get that overnight. So in addition to selling their securities at a loss to free up some cash, they're also looking to sell $2.25 billion worth of new shares in their parent company on the stock market. Well, that didn't go according to plan either. What exactly was their plan? Well, they wanted to raise that $2.25 billion to shore up their balance sheet, meaning everybody who has money in the bank could, in theory, withdraw their cash and the bank would be fine. Now on paper, that's a good thing to do, right? Hey guys, we're a little short in cash. We sold some things so that we have cash, so everybody's good. Well, everybody went, I thought we were already good. We're not good? Basically, all the key VC firms, including Y Combinator, who had over 1,000 different companies in their portfolio that banked with SVB, called up all the companies in their portfolio and said, hey, get your money out now. There's going to be a bank run. So in an effort to get ahead of a bank run, they caused a bank run. That's right, everybody. We are our own worst enemy. Now, before the collapse, SVB had over $21 billion worth of treasury bonds, making an average interest rate of 1.79%. Now, when interest rates were basically 0% a few years ago, it's not bad. It's at least something. But now the average treasury bond rate is 3.9% for a 10-year bond. And while that's more than double what SVB was primarily holding. So on Wednesday, SVB sold some of their lower performing securities to free up some cash, sent out this press release, and spooked the world. Come Thursday, their stock fell more than 60% by the end of the day, and an additional 20% after hours trading. That's 80% gone in 24 hours. An additional $42 billion worth of withdrawals were also taken out within the first 24 hours, and that was the nail in the coffin for SVB. What SVB didn't expect is that their transparency would inevitably be their downfall. So what does that tell you about capitalism, boys and girls? By Friday morning, trading of SVB stock was halted, California regulators stepped in, and the FDIC took over. Now, the FDIC insures every single bank account up to $250,000. The problem is about 2.75% of all the funds that SVB had are FDIC insured. That means 93% of the funds in SVB's holdings are not insured because either one, they were foreign investments, which are not insured by FDIC, but the primary reason, because most of these companies and accounts had way more money than that. I mean, we're talking about companies that had multi-million dollar, $100 million, maybe billion-dollar valuations. They're gonna have a lot of money in the bank. Some people are comparing SVB's fallout to FTX's fallout. And while on the surface, there definitely are a lot of similarities, there are some key differences here as well. I won't do a full deep dive into this, but basically FTX was not insured at all, and that was more malicious and scam. And basically SVB didn't have the cash they needed when people withdrew. So that's kind of true in both situations, but for slightly different reasons. So I'm not really gonna draw many parallels there until we know a lot more on the SVB side. So maybe that's a video for another day. So is this bank collapse the start of a bigger collapse within the US economy? Well, Most experts say not quite. While this is a multi-billion-dollar failure, it is primarily in the tech startup space and venture capital space. So while those industries are going to be heavily impacted, some predicting about a decade's worth of financial headaches, losses, and technological losses, vast majority of the economy will be unfazed by this bank collapse. So while this absolutely sucks for the people that are in venture capital and tech startup industry, whether they're employees or founders or the investors themselves, it's not going to be a big deal to the average consumer, which is a good thing at the end of the day. I've been speaking with some of my founder and VC friends that have companies that used SVB, and while off the record, a lot of people are saying there's going to be some changes. Some companies will be a-okay, they have money, they can keep their payroll. Some will get temporary loans or advances on investments from VCs to cover payroll while that money is being unlocked by the FDIC within SVB's former assets. But not every company is going to make it. Some that were very young or razor thin at all might not have the cash flow and cash reserves to stay afloat while their money's being sorted out. So that would kind of suck if you go bankrupt even though you have a bunch of money just locked away because you can't access it. So while I'm sure there will be headlines for weeks and possibly months to come on what happens next, right now I think you can breathe a sigh of relief that this ain't your problem, but it is something worth learning about, and that's why I made this video today. So what are your thoughts on this bank collapse? It's massive. While bank failures are not necessarily uncommon, and the FDIC definitely know what they're doing when it comes to fixing this one was pretty big and pretty fast, and it shows no matter how much money you have or how smart of an investor you are, you can lose it all, sometimes quite literally, overnight. If you found this video interesting, please subscribe. It really does help out this brand new channel. I make videos about investing, personal finance, and finance news so you can stay in the loop, in the know, and make better money moves. If you want to learn how to make some money, hit that subscribe button, and I'll see you in the next one.